Welcome to our video on escaping generational poverty by transitioning from safe saving to smart, growth-oriented investing. Today, we'll focus on a real-world context. A $143,000 salary, zero debt, $240,000 already accumulated by age 34, and $30,000 in cash reserves. We'll explore why that strong foundation still benefits from a financial literacy upgrade, especially if early retirement at 58 is the goal. We'll cover how to deploy excess capital beyond a mandatory pension structure, potentially over 38% total contributions, including an employer match, toward an aggressive brokerage strategy. Along the way, we'll unpack the mindset shift from fear-based saving to confident, long-term investing. Let's begin. Here's the roadmap. First, we'll frame the mindset shift. Next, we'll assess the current foundation. Then, we'll move into a three-part action plan: housing timeline, maximizing tax-advantaged accounts, and aggressive brokerage investing. After that, we'll visualize decisions with a diagram and design a sample aggressive portfolio. We'll compare high-yield savings to index funds, run illustrative bridge to 58 scenarios, test your knowledge with short quizzes, and finish with key takeaways and next steps. Before we proceed, please note, this content is for educational purposes only and does not constitute financial, tax, or legal advice. Everyone's situation is different, so consult a qualified fiduciary advisor or tax professional to tailor decisions to your goals, timeline, and risk tolerance. With a strong income and no debt, the core challenge changes. Instead of meeting basic needs, you're optimizing how to grow wealth efficiently. Your mandatory pension and employer match form a secure retirement baseline. But early retirement at 58 requires a deliberate plan for the money you control outside that pension, especially if you regularly save more than $2,000 per month. The key is ensuring excess cash doesn't sit idle. Let's clarify your baseline. Your gross income is around $143,000. With zero debt, you maintain an emergency fund of about $30,000, which protects you from short-term shocks and should be preserved. You've accumulated roughly $240,000 by age 34. Which is an excellent head start. Your mandatory retirement contributions and employer match can be more than 38%, providing a secure long-term floor. Your early retirement target is age 58. You often have more than $2,000 per month available outside of the pension. The key is ensuring that surplus does not remain idle in a high-yield savings account when it could be compounding in growth assets. Here's a mindset shift. Many high earners develop savings inertia. Building large cash piles feels safe, especially after experiencing financial scarcity. While understandable, it imposes a hidden long-term cost by missing compounding opportunities. Instead, shift from fear-based saving to growth-oriented investing. Time in the market can turn volatility into an ally. The simplest way to overcome hesitation is automation. Set recurring investments so growth happens without constant decision fatigue. Here's the three-pillar plan. First, separate your housing goal. If you plan to buy within 1 to 3 years, keep that money safe in cash-like instruments such as certificates of deposit, treasury bills, or a dedicated high-yield savings account. Do not invest the down payment in the stock market. Second, maximize tax-advantaged accounts beyond your pension. This can include IRAs, health savings accounts if eligible, and any supplemental retirement plan offered by your employer. Prioritize these shelters before taxable accounts. Third, use your brokerage account aggressively. Because your pension provides a retirement floor, the brokerage can take on a higher equity allocation using low-cost index funds to drive growth. This flowchart shows how to route each month's surplus. Start with whether a housing purchase is planned within 1 to 3 years. If yes, keep those funds in a safe cash bucket like CDs, treasury bills, or a dedicated high-yield savings account. If not, check whether you've maximized tax-advantaged options like IRAs, HYSAs, or supplemental retirement plans. If you haven't, fund those first. If you have, allocate the remainder to a taxable brokerage account with an aggressive index-based allocation. From there, automate dollar-cost averaging, rebalance periodically, and consider tax loss harvesting where applicable. Ensure your emergency fund remains at roughly 6 months of expenses, topping it up if needed. Finally, review your goals and risk annually to stay aligned with your plan. In the aggressive brokerage, a common framework is 80 to 90% stocks and 10 to 20% bonds, adjusted to your risk tolerance. Core holdings can include total U.S. market and total international index funds. You can optionally add a small cap or value tilt for diversification and potential factor exposure. Focus on process rather than prediction. Automate contributions with dollar cost averaging and rebalance on a set schedule, such as quarterly or semi-annually. Improve tax efficiency with long-term holding periods, tax loss harvesting when appropriate, and asset location by placing tax-inefficient assets in tax-advantaged accounts if possible. Finally, write an investment policy statement to define your allocation, rebalancing rules, and risk boundaries so you avoid emotional decision-making during volatility. Here is the trade-off. High-yield savings accounts offer principal stability, liquidity, and federal insurance within limits, which makes them ideal for emergency funds and near-term goals like a home purchase. However, they deliver lower long-term returns and can lag inflation over decades. Broad index funds historically offer higher expected returns and the power of compounding, making them suitable for long-horizon goals and bridging the income gap before pension access in early retirement. The trade-off is volatility and the need for behavioral discipline through drawdowns. Allocate based on time horizon and purpose. These are simplified, illustrative scenarios for age 58, not guarantees or advice. Assuming 24 years from age 34 to 58, at a 7% annual return, the existing $240,000 could grow to roughly $1.2 million. While investing $2,000 monthly could reach about $1.5 million, for a total near $2.7 million and a hypothetical 4% annual draw of about $108,000. At a 4% annual return, the existing $240,000 could grow to about $614,000, while the $2,000 monthly could reach approximately $964,000, for a total near $1.6 million and a hypothetical 4% draw of about $63,000. Actual outcomes vary, and taxes, fees, asset location, and sequence of returns all matter. Quiz time. Which bucket is most appropriate for a home down payment needed in 1 to 3 years? Option A, an aggressive index fund portfolio. Option B, a high-yield savings account, certificates of deposit, or treasury bills. Option C, a cryptocurrency fund. Option D, individual growth stocks. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. For a 1 to 3 year time horizon, prioritize principal safety and liquidity with high-yield savings, certificates of deposit, or treasury bills. Short-term funds should not be exposed to substantial market risk. Second quiz. With a strong pension baseline, what is the brokerage account's primary role? Option A, replicate the pension's conservative allocation. Option B, serve as the aggressive growth engine to fund the age 58 to pension access gap. Option C, hold most assets in cash. Option D, time the market with short-term trades. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Because the pension serves as a safety net, the brokerage account can be positioned as the growth engine designed to bridge income needs between early retirement at 58 and when the pension becomes fully accessible. To make this stick, automate transfers the day after each payday. Use separate accounts for clarity. One for the emergency fund, one for the house down payment, and one for the brokerage. Draft a one-page investment policy statement that defines your allocation, rebalancing cadence, and risk limits. Schedule quarterly check-ins that take around 15 minutes, and an annual deep review to adjust for life changes. Keep friction low by pre-scheduling orders and setting alerts rather than making ad hoc decisions. Separate near-term cash needs from long-term investments. Maximize tax-advantaged accounts beyond the pension. Use the brokerage account aggressively with low-cost, diversified index funds appropriate to your risk tolerance. Automate contributions and rebalancing to overcome inertia. Finally, allow compounding to work over decades by staying the course. In summary, decide your housing timeline and protect those funds in safe cash instruments. Audit and maximize your tax-advantaged accounts. Launch or refine an aggressive brokerage allocation using diversified index funds. Automate monthly contributions and rebalance at a regular cadence. Document your investment policy statement and schedule annual reviews to stay aligned with your goals. Thanks for watching. If this video helped you progress from safe saving to confident investing, please like the video, share it with someone who's building wealth, and subscribe for more deep dives. In the comments, tell us, what's one mindset shift you're making this year to move from saving to investing? Your story might inspire someone else.